Hey, how are you? Hope all of you are well. It's your CPA Manish here on Sunday, the 20th of November, 2021, bringing to you this next episode on our series on all things real estate. And today we are going to discuss one of the most powerful and rare tool in real estate, which helps us not only defer taxes and eventually save taxes, but it also helps us to build our wealth and pass appreciated properties to next generation. It's very rare in tax codes that you would find a tool as powerful as this. And we are talking about 1031 exchange. So today we are going to discuss about 1031 exchange. If you remember, the way 1031 exchange works is that I'm going to simplify it, but if you have a property which you bought for say $500,000, and now the property is appreciated to say $1 million, and you have a built-in gain of $500,000, if you simply sell this property, then you will have to pay capital gain tax on that gain of $500,000. Okay, so what you can do is you can instead opt to do 1031 exchange, and by doing 1031 exchange, what you will do is whatever proceeds you get from the sale of this property number one, which is say $1 million, you will roll it over to another property, let's say property number two, and put that $1 million all into the second property. Okay. If you do that, then you can defer paying any taxes on that gain of $500,000 that we initially spoke about, which was on our property number one. Okay. Now let's take our example further and say years down the line, again, property number two, which we bought for $1 million, is now worth say $2 million. And now there is a gain of $1 million. Again, if you sell without any 1031 exchange, you will have to pay tax not only on that $1 million of gain on property number two, but remember you already deferred $500,000 from the first property also. So now you will end up paying tax on the gain of $1.5 million if you sell property number two. But then what you could do is sell property number two and do a 1031 exchange and roll over all the money into property number three. If you roll it over into property number three, then you are able to defer taxes on the gain of that total $1.5 million. And again, you will be able to do a 1031 exchange. And this you can do potentially all your life. From property number one, defer the gain, put it into property number two, don't pay taxes. From property number two, roll it over to property number three, defer the first one and the second one, everything, don't pay taxes. From property three to property four, four to five, and so on. And the plan is, and the intention is, that if we are able to do this roll on all our life, and then we do not finally sell the rollover property, the 1031 exchange property, and if we pass away, then what happens is on the date of our death, that final property, whatever that number is, property number 2, 3, 4, whatever the final number property is, that property will pass on to our beneficiaries at what is called as a stepped up basis. And when they get this at stepped up basis, then all the built-in deferred gains for so many years that we had been doing, all those gains will be then wiped off, and our beneficiaries will not have to pay any tax on all these gains, all these years that we deferred and built in, that will all be exempted. So that is how the 1031 exchange works in a nutshell. Very powerful tool, very rare tool. Tax code rarely has this kind of regulations available for us to use. So that is what we are going to discuss today, 1031 exchange. Now, it is called 1031 exchange because it derives its name from Internal Revenue Code section, and that section number is called 1031. So the section number 1031 enlists all the regulations, all the guidelines that we have to follow to do the 1031 exchange. That's why it's called 1031 exchange. It is also called like-kind exchange. Like-kind exchange because what you are doing here is you are exchanging one old property for another new property. So there is an exchange, and the exchange has to be like-kind. Not getting too much into the terminology here, like-kind means that if your old property is a rental property, the new property should be a rental property. In simple terms, that's what it means. It doesn't mean that you cannot exchange a single family home for a multi-family home, or a multi-family home for apartment building, or an apartment building for a single tenant property, or a single tenant property for a commercial building or an office building. There is no restriction, so to say. All these properties that I mentioned are all allowable. 1031 exchange works with all these kinds of properties, whether it's single family rental unit or multi-family rental units, apartment buildings, office buildings, commercial space, single tenant leases. All these rental properties you can do 1031 exchange with. And there is no restriction on what property should be on the front end and what property should be on the back end, in the sense, what are you selling vis-a-vis what are you buying? The exchange can be cross exchanged also. As I said, the example is if you sell a single family home, you can buy a multi-family home also. There is no restriction as such. So 1031 exchange is very versatile. It can be used in almost all rental properties. It cannot be used for two specific properties. It cannot be used on your primary residence. That is not allowed. Primary residence, of course, has a $500,000 exemption under a separate code, which we can discuss in future videos. But for the purpose of today's video, 1031 exchange cannot be done with primary residences, and it cannot be done with fix and flip properties. So if it's your primary residence, you cannot do 1031 exchange. And if you are fixing and flipping a property, you cannot do 1031 exchange. Other than that, you can do 1031 exchange with almost any kind of rental property. Okay. So with that, let us now discuss how this procedure of 1031 exchange works. So let me explain that to you. So let's learn this by an example. So say this is you, and you have a property which you want to sell to a buyer. So you have a rental property and you have decided to sell this property to a buyer. Usually the way it works is when you need to sell the property, you transfer the deed of that property to the buyer. And usually the buyer gives the money, the sale proceeds back to you. So that's the normal sale procedure. You transfer the deed to the buyer and buyer gives the money to you. In 1031 exchange, listen to this, you cannot touch the money. In 1031 exchanges, you cannot touch the money. So the buyer will not pay the money to you. The buyer will have to give this money to somebody that is called as a qualified intermediary. So you will hire a company or a firm or a person who will be a qualified intermediary. And even though you will transfer the deed to the buyer would not give the money to you. You cannot touch the money in a 1031 exchange. The money will go to a qualified intermediary. Okay, you have to appoint a qualified intermediary. The qualified intermediary, or we call it a QI. A QI is a licensed professional. So qualified intermediary cannot be your accountant or not necessarily your attorney or it cannot be your friends, relative, anybody else that you know. It is a QI who is a licensed professional who does the business, who is in the business and profession of being a QI. And when you hire a QI, this is one of the most important hiring that you will do in this process. You have to have a QI who is very reputed, who has proper insurances, who has a good history, you've got good reviews about them, and then you hire a QI, because if the QI doesn't execute this whole process correctly and messes up with the dates or timelines, your 1031 exchange could be in jeopardy. So you want to be very careful in hiring a proper QI. Also understand that QI is like a person who is going to hold all your money in an escrow. So there is going to be a lot of money sitting with the QI for a very long period of time. All this money from your sale is going to go to them, and they are going to hold it for a very long period of time. So you need a QI who is very reputed, very strong, and you're covered with insurances and things like that. This is one of the most important professional you will need to execute your 1031 exchange. Okay, so that is the QI. So again, you sell the property and you transfer the deed to the buyer, but the buyer cannot pay the money to you. It goes to an intermediary, qualified intermediary QI, and QI is going to act as an escrow, and he or she or that firm is going to hold all your money with them for the next step of 1031 exchange. Okay. Now, once this sale happens, right, your timeline begins. Once this sale happens, your sale closing happens, that is when your timeline begins. So after your sale closing has happened, you have next 45 days, you have next 45 calendar days, and this 45 days or 45 calendar days period is what is called as an identification period. Okay, so you have sold, the money is sitting with the QI, the date QI got the money, from that date to next 45 days, that 45 days period is called as identification period. Identification period because in those 45 days, you are now going to search and find and identify 3 properties that you would potentially like to buy. Okay, you already sold. Now the process starts, the timeline starts, and you have 45 days within which you will have to search, find, and identify 3 properties, one of which you are going to actually buy back, one of which you are going to close, one of which you are going to buy back. That will complete your 1031 exchange. Okay, so this 45 days period, the identification period, is very important. Few things to note: there is no extension. These deadlines, these timelines are like set in stone. These are non-negotiable timelines, deadlines. And this 45 days are calendar days. So it doesn't matter if there is a holiday or if there are Saturdays, Sundays, weekends. These are 45 calendar days strictly available to you for you to search, find, and identify 3 properties, one of which you are going to close. Okay. Once you identify these properties, you can identify 1, 2, or maximum up to 3. Once you have identified the 3 properties that you might want to buy, you might want to close on, you might want to get in exchange, then you have to fill in the identification forms with the QI. You have to approach the QI, you have to meet QI, and you have to fill in the identification forms. And on those forms, you have to specify which of the 3 properties are you going to identify, one of which you are going to buy, one of which you're going to close on, one of which you're going to take in exchange. Again, the way timeline is set in stone and is non-negotiable, this identification form is also non-alterable. So you cannot make any alterations once you have identified these 3 properties. Okay. One of the questions that I got in your emails is, what if I want to identify more than 3 properties? What if I want to buy more than one property? I want an option of more properties to buy. Because remember, in 1031 exchange, also it is not like if you're selling one property, you have to buy only one property. Okay. The value of the exchange should be equal. But if you sell one property for $500,000, for example, you can buy 2 properties, one of which will be 200,000 and another will be 300,000. The total has to be $500,000. Okay. So the value has to be same, but number of properties can be, you can sell one and buy multiple, or you can sell multiple and buy one, right? So this question comes up that what if I want to identify more than 3 properties? Am I allowed to do that? And the answer is yes, you can identify more properties, more than 3 properties. But then the condition is that if you identify, say, 4 or 5 or 6 or 10 or 20, unlimited, as many number of properties that you identify, the total value of those identification, the total value of those identified properties cannot be more than twice the value of the property that you sold. Okay, so can you identify more than 3? Yes, you can identify unlimited properties, as many as you want, but then the total value of your identified properties cannot be more than twice the value of the property that you sold. So if you sold the property for $500,000, then you can identify as many properties as you want, but the total value of those identified properties cannot be more than $1 million, cannot be more than twice what you sold. Okay. Okay, moving forward with the timelines. Once you have this 45 days of identification, after those 45 days, you have another 135 days within which you will have to buy the property that you want to buy. So first 45 days after your sale was the identification period. And after 45 days, you have another 135 days within which you have to actually buy, actually close on one of these properties or multiple of the properties that you had identified in your identification form. Okay. So if you see the timeline, the total timeline is 180 days from the date you sold your property. So from the sale of property, you have total 180 days, but that 180 days is divided into first 45 days as identification period. And once you identified 3 or more properties, you have another 135 days when you have to close on one of these properties or multiple of these properties to do your 1031 exchange. So this is how the timeline works. So when you're ready to buy, when you know which property finally you're going to buy or you're going to close, at that time, again, what will happen? The seller of that property will transfer the deed to you, but you could have guessed that you won't be paying money to the seller directly because the money is sitting with whom? The money is sitting with the QI. Remember the property that we sold, we did not get the money. We did not touch the money. The money was sitting with the QI. Now the QI is the person who is going to pay the money to the seller. Okay. So this is how the whole 1031 exchange works. One more thing which is very, very critical, very, very crucial in 1031 exchange. If you see on your screen, the value of the property that you buy should be at least equal to or more than the value of property that you sold. In a 1031 exchange, the value of the property that you buy should be either equal to or more than the value of property that you just sold. Number one, first condition. And second condition, which people are not very aware of or they miss it many times, is that during this 1031 exchange, if you buy a bigger property or during this exchange for expenses and things like that, if you have to put in the money, then the dollar amount that you put in during this exchange, whatever you put in from your pocket outside the exchange, whatever you have to put in from your own savings, plus whatever is the value of your new mortgage, whatever is your new loan, okay, what you put in plus your new loan should be equal to or greater than the old loan or old mortgage that you had on the property. Okay, both these conditions are necessary. Condition number one, the value of the new property that you're buying should be equal to or more than the value of the property that you're getting rid of. Okay, so same value or more. And at the same time, the money that I have to put in plus the new loan should be equal to or greater than the old loan or old mortgage that I had on my old property. Okay, let me give you an example because I encountered this with one of my clients. Okay, let me stop share and give you an example. So what happened is I had a client who sold a property. It was a commercial office building for $18 million. Okay. And when he sold that property for 18 million, he had mortgage on that property for $14 million. Okay. He sold the property for 18. He had mortgage left out of 14 million and 4 million was his equity. Okay. So that was the whole transaction. So when he sold this property for 18 million, he was under the impression that out of 18 million, let me first pay the mortgage of 14 million. And then whatever 4 million will be left with me, if I do 1031 exchange only with that $4 million, then all my capital gains will be deferred and I won't have to pay any tax because look, I did not take any money out. I did not touch the money. 18 million came in, 14 million went to the mortgage. 4 million I'll put into another property, small property, and I'll do a 1031 exchange and I should not have to pay any taxes. It should be deferred. That is not correct. That is not true. That is wrong. Because first of all, you sold for 18 million. So your new property should be at least 18 million or more. So you cannot buy 4 million and defer the taxes. Your old sale is for 18, your new sale has to be for 18, first of all, condition number one. And condition number two is that if you had to put in some money extra during this buyout, right, and the value of your loan should be at least equal to or more than the old loan. Okay, old loan. Here, old loan is $14 million. Okay, so $14 million, you have to keep the loan plus 4 million, you cannot touch the money. So your total investment should be 18 million or more. That is when you could have successfully done this 1031 exchange. That is how this 1031 exchange works. Okay. Look, you should plan for 1031 exchange whenever you sell a rental property. I highly recommend that. As I have multiple times said, even in this video, this is a very powerful tool. And you should at least try to do 1031 exchange. I tell all my clients all the time that when you sell something or are you in a process of selling something, you start with the notion that you will try to do 1031 exchange. So start the whole process with the intention of doing 1031 exchange. Tell your attorney, I'm going to do 1031 exchange, hire a qualified intermediary, do the closing, transfer the deed, don't touch the money, let the money go to the QI, okay? And try your level best to identify properties in 45 days and then close it in 180 days total, okay, calendar days. And if you can do it, that's good. That's amazing. If you can't do it, you are going to pay tax anyways to begin with, right? So if you can't do it, so be it. If your 1031 exchange fails, that's okay. There is no penalty that you tried and you were not able to do it. The only caveat is you thought you will not pay tax and now it fell through. The 1031 exchange did not go through. So be it. You will have to pay taxes, which you are going to pay anyways if you did not start or try doing 1031 exchange. But keep your eye on the price money. imagine if you are able to do 1031 exchange, then how much it is. Let me give you a perspective. If it's a $500,000 of gain which you are able to defer, if it's a $500,000 of gain which you are able to defer, even if you are in the 30% bracket, long-term capital gain rate is 20% long-term, plus there is 3.8% net investment tax, which is another surcharge of 3.8, plus you will have state taxes. So total 20 plus 3.8 plus state taxes, it comes to around 30%. So if it is $500,000 of deferral that you are able to achieve, 30% of that is $150,000. So you will now have additional $150,000 to invest. I will now have additional 150 to invest. An additional 150, if I'm going to do 25% down payment and take 75% loan, if I have additional $150,000 and I'm going to do 25% down payment and take 75% loan, I can buy a property worth $600,000 just because of this tax deferral, just because this money is not going to go to the IRS and is going to sit with me. That 150 gives me a purchase power of $600,000. So $500,000 of deferral allows me another $600,000 of property built up, another $600,000 of my estate built up, wealth built up, which eventually I can pass on to my beneficiaries. It is huge. It is huge. It is complicated a little bit. It is inexpensive. The qualified intermediaries and everything doesn't cost you more than $1,000 or $1,200 or something. So it is inexpensive, completely inexpensive. It is an amazing tool. It's a little bit complicated. It's not as complicated as the fruits of doing 1031 exchanges are. So I highly recommend you should plan everything. You should plan the sale accordingly. You should adjust the date of your sale in a way that you are able to identify the properties in 45 days and you are able to close within 180 days. You can maneuver around the dates by adjusting the date of your sale and things like that. So if planned properly, this can easily be done. And again, I cannot stress enough, it's an amazing tax deferral tool, tax savings tool, asset protection tool, estate development tool, a wealth production tool. It's amazing. Okay. I hope this was helpful to you. I think the next video would be the last video in this series of all things real estate. I have still few questions from all of you with regards to how to gift the real estate and then how to do the valuation if you are gifting the real estate and how can we use that in estate planning. So that should be our last video in this series. So I'll see you soon. Take care. I wish you all have a very happy Thanksgiving next week and I'll see you soon. Take care. Bye-bye.